Hello and welcome everybody. Thank you for being with us today. We are broadcasting live from Park City, Utah, which I can't seem to leave. I've been here since June. Most of the time, it's been super exciting and love it out here. So I know that you guys are probably accustomed to being here. And so, like I said, I can't seem to leave Park City. I'm loving it. Also, Peter you're in Connecticut?
I'm in New York,
actually. In Westchester, New York, yep. And so thank you all for being here. As usual, thank you for supporting Family Office Insights and our webinars and everything else you do for the community. We super appreciate it. I have to give a big thank you to Jennifer Ferron, who's a longtime friend of mine in New York City, who introduced me to Sandy, who works with Peter. And Peter is going to share with us some interesting information, and we're going to do this more like a fireside chat as opposed to a pitch today. You know, we call these the Luminary series because Peter is actually a luminary, and once you see his background, you'll see why. Is also in what he's executed here. So for the record, we're recording this. We're going to put it on the Family Office Insights YouTube channel after. So if you want to review it or you care to share it with others that might benefit from knowing what you learned today, you're welcome to do so. And we'll also, for the record, make sure that you can be directly in touch with the folks at Troob if need be. Again, we're just trying to highlight what Peter's doing here. And so if you're interested, you're again welcome to connect with him directly. So with that, Peter, you want to introduce some background and then chat a little bit?
Sure. And thank you. And thank you to Family Office Insights to inviting me this afternoon, or at least it's my afternoon. I think for some of you guys, it's probably midday. I just want to tell you a little bit about what we're doing, and then hopefully, we'll just talk about it, and we'll talk about how it fits within the markets today. So we provide capital. We really provide capital solutions that solve liquidity needs of companies and entities. And it's really in the smaller space. It's below $20 million. Now, that doesn't mean it stays below 20, but usually the initial need is below 20. And so that's to either, buy assets, growth capital for companies, rescue capital. It's a pretty low visibility market that I would call hard to access. And I think through a lot of pretty much hard work and what we do, we've been able to access it. So it's through constant sourcing, and really it's through an investor base that gives us referrals. We have a pretty robust investor base of pretty much wealthy family offices and individuals, and that allows us to see things that we wouldn't otherwise see. And after a pretty long history in the marketplace, we've seen, and I think we continue to see, a disconnect between the number of opportunities in the market and the amount of experienced capital looking for those opportunities of that size. The banks don't really want to do it anymore, and the larger funds, it's too cumbersome and too small. That just leaves us with a pretty good opportunity set. And we know what we're looking for. Really, it's large margins of safety and large embedded unlevered returns. We're just presented with a need for capital, and we craft a solution. And in some ways, that allows us to control our entry and even our exit. I mean, we have to source and execute, we have to evaluate and execute, but then we have to, monitor and exit. And I think a lot of investors, it's easy to get into an investment. It's hard to get out. If you write the investment, if you craft it from the beginning, you can start crafting an exit on your entrance. In my view, this space is massive, much bigger than what we could deal with. It's growing, it's untapped, it's really not even brokered, and it's unsophisticated. And it's going on all over the country. I'm sure it's all over the world, where there's needs for capital that are being widely and wholly unmet because they're either not big enough, which is sort of a weird concept, and no one cares. So it goes to this number where it's like too big for the country club investment group and too small for big players. So an $11 million need is not nothing, but no one takes the time to do the work and go through all the pain of figuring it all out to make the money on it.
Peter, can I just ask something? Because it's really
Sure.
interesting terms, right? When you say exit, is it most often just paying off debt?
No, sometimes it could be paying off debt. That would be the most easiest way. Sometimes, of course, we have warrants in the back end. There's equity involved. You have to structure it many times in a preferred way that you have an ability to take your class and say, it's time for me to leave because I'm not in it for a decade. I'm in it for 3.5 years or 5 years. And if you're beholden to being a minority interest player, you basically are told you'll get your money when you get your money. We don't like that. So you can structure things with put options. You can structure the ability to transfer and sell your interest. But remember, a lot of these, if you look carefully at contracts, they don't allow you to do these type of things. If you structure the investment, you can structure it with those with that kind of control. I would say the way we do it is if we're relinquishing the control to get the money back, at a certain point, that mechanism will switch back over to us to allow us to then take control of the whatever entity or thing it is and sell it. And what I've always said, we've been investing for a while now, and through '08, when people didn't give people money back, their argument was there's no liquidity. My argument was there's no liquidity at the price you like it. There's always liquidity. And so it annoyed me. I don't like selling in a disaster scenario at $1, but someone will pay you $1, right? So that doesn't, I want to at least know that if I have to, I can get out. That's all about structuring investments at the beginning. Like if you're figuring that out in the middle, it's too late.
Too late,
like,
yeah.
It's
There's usually always a bid, but may not be a bid that one likes, right?
And it's always when you need the money, right? Yeah. So I think like the hardest part is we try to structure ourselves to turn the capital that we invest, both for our family, ourselves, and for investors within a 5-year period. And that's hard because, sometimes you want to do things for longer and there's a good reason to do that, but you should you don't want to be forced into that. Like I see a lot, suddenly a 3-year investment's a 10-year investment. That's not a good outcome usually. So for us, structuring things that we can actually exit is very important. And, you can do it in multiple ways, and you can do it, by the way, in a very tax efficient ways. If you think through it at the beginning, you can create QSBS status, which is like a qualified small business status, that you can get involved in assets that you can depreciate all up front. There's a number of those. These are all, if you think about it before the investment is toppling over on you, you can actually like create good investments, sort of at least feeling, again, as I say, that you control your entrance and your exit.
Really so you brought up qubits. I think that's what they're called, the qualified business assets.
Yep.
And the audience, some of them are quite familiar with that. Do you, and I'm not asking to get legal advice, but did that survive the latest round?
I think so. Again, I as far as I know, yes.
Yeah.
Again, if you're dealing in a small enough space, from what I understand so far, and from what I understand, yes. Yeah. You can, you have to stay under 50 million. There's a whole bunch of things, and it's certain areas like
C-Corp, the whole thing. Yeah.
It goes on and on. But look, small business, it's weird because when I start a long time ago, my family owned the largest small business brokerage company in the country. It was called Geneva Companies.
I remember Geneva. They used to take full page ads out in the Wall Street Journal, right?
Right.
Yeah.
And we sold it to Citigroup in 2000. And what's interesting is for all I hate to say it, it's like lip service now in politics about small business. Well, they used to talk about small business all the time. Now they don't even talk about it. Like there is no lip service. Effectively, it's sort of forgotten. But it's still a tremendous amount of this country, and it's where all these things started. And it sort of bothers me in some respects that no one really pays attention. And so if you're a small business looking for money, you have to go to a bank, you have to have personal guarantees. They're all over you. It's unbelievable the questions and answers that you have to give. you're a monster business and you want to borrow money in the high yield market, it's like, it's like thrown at you like it's like water. And that's just the way the world is. So unfortunately, the cost of capital for a small business trying to grow is very high. And people, what I'm trying to explain to some of these small businesses as we get involved with them is they could sell 10 widgets at 30%, or they can sell 100 widgets at 22%. And most small businesses aren't thinking about margins, they're thinking about money. And they say, well, I do the math, I'd rather, and so that difference of 22 to 30 is what we take. So many times are what you would call them secured. They're not always loans. Sometimes just they're secured investments. Will get a piece of revenue, not a piece of a guaranteed stream of like an interest rate. And I always say to people when I invest with these companies is, if you're in a seasonal business, why do you pay a fixed amount of money on a loan? I mean, why don't you pay it seasonally? I mean, it's not that hard. So
Cash flow, right? Yeah.
it makes sense. I mean, if
Yeah.
you're going to be cash flowing at certain points, then maybe you should be paying more at those points. If you can be a little more flexible as either the lender or the inventory provider, the secured provider of money, you can create cash flow streams off of assets that otherwise didn't create, that otherwise you couldn't borrow against. And that, I think, is where I think a little creativity can go a pretty long way, actually.
Yeah, taking a little piece of the gross revenue. It sounds kind of interesting, right? That could get you where you need to go.
It's also a number, by the way, that is much more easily definable. I'm not saying we do this every time,
Yeah.
but sometimes you just can't figure out what a company makes. You can try your best, but it's a little bit lumpy and weird. But you know what revenue is? That's pretty much, you sold it, you got paid for it.
Yeah. Yeah.
So again, I think, though the accrual method of accounting is always very interesting, I think in the world that we live in, it's about cash. It's about cash out, cash in.
Yeah.
It's simpler to think about it that way.
So how do you think about collateral in general?
Yeah, I mean, the way we do it, and I over the years, I managed debt funds and secured vehicles. I love security and I love being secured. But the reality is I like ownership more. Security allows you to establish your contract right and go after them in bankruptcy. Sounds good, but I've done it before. It's a big pain in the ass.
It's an unpleasant.
Right. If you own the asset, it's yours. Again, most times you can't do that if assets are really large, but in the things we deal with, we own the asset and almost in many of our investments. And then what we do is we literally consign it to the operator. So we turn an asset into a cash flow stream, but it's our asset. And now the only difference is when there is a problem, which, I can go and take my asset and walk away. And now maybe it's too big. You can't actually put it in your pocket, but you could have it shipped away. It's yours. It's your title, your ownership. I like that. It sets you up in if you have multiple operators in the same industry, it gives you flexibility. If somebody gets a little squirrely on you, instead of having to deal with them through a process, you say, I think I'm going to take my asset and move it.
So you already have a perfected interest in the title of the asset, so there's no fighting.
There's not, I mean, people can still look possession. People say, I'm not giving it back, but title is title. And with title, you have many more rights. You don't need to go through a bankruptcy process to get. And so I like that. You can't always do that. But and by the way, it carries some risk too, because with title, you have liability risk of that asset, something were to happen due to that asset. You own your property, and then someone dies.
Someone gets hurt or whatever. Yeah.
Right. So you have to have, there's some extra costs by owning things versus just being the secured party. So you have to be careful and think about insurance.
You have to insure them and all that business, right?
And additionally insured, and it's complicated, but in the long run, I've found that, at least for the type of things we do and in the size we do them, owning the asset is a better alternative and gives you more flexibility than just being secured by the asset.
Yeah. So before we talk about, you've got a fund that's actively raising, but before we talk about that, can you just, without disclosing who it is, give us an example of something that you've done recently or two that you like, the type of business, how you structured it, that sort of thing? You don't have to go crazy, but just
No,
an
I'll go
example
crazy,
to-
but like I'll give
Yeah.
someone, this is an idea. And again, these type of things, it's, it takes us sometimes 6 months and sometimes years to actually get comfortable with a space. And so by the time we do it, sometimes it looks like, oh, that's eclectic and weird, like, but it's not as if we saw it a week ago, you
Right,
know?
right, yeah.
So to give you an idea of like airplane, parts, and most people know the engine part world. There's another part of that world in the landing gear. And it's an interesting part of the world because it's the third most expensive part of the plane, which, aside from engines and sort of fuselages. And then it also needs to be changed out in aircraft by time, not just by cycles. So even when there's no flying due to COVID, the airplane leans on its landing gear. So you have to switch it out. So there's a constant need for replacement parts, fixing them and refurbing them and putting them back on. Once an airplane is created, there aren't a lot of OEM landing gears they don't put like another 1,000 on the marketplace. That's not the way it works. So you have an asset that we buy them, and we do it under very, very specific types of planes. Like you've got to know what you're doing in the type of plane. And we have an operator that we work with to do this. And we can then turn that asset into a cash flow stream. We can lease them to an airline. So we're taking airline credit risk, but of course we own the part. So even if the airline were to go bankrupt, if you go back to the way that when the airlines went bankrupt,
Sell it to somebody else. Yeah, yeah.
well, and they pay those. That's a critical vendor, right? They pay you. So, so you could actually sell them. You buy it and you can sell it, and you can actually do a thing called an exchange program where you give them the one that's been refurbed and they drop off the one that needs to be fixed. They give you money to fix it, and so that the next time they need a landing gear, you've got it for them. That's the best, in my view, of all worlds. You have ownership. They give you, of course, money plus a fee to fix the part.
And they give you the equipment. You have the
and they give you the equipment, right?
Yeah.
So, that's the type of business for us. It's like, is that ownership? Is that equity? Like, is that a bond? What is it?
Yeah,
And
yeah.
in my view, it's secured, piece of paper. You're owning it, and you're creating a cash flow stream, a very good cash flow stream. And it's not like it's a business that if you're a monster player, could you put $1 billion worth? You could, but the reality is, this is a $10 to $25 million type of working order with an operator to be their inventory provider of this gear. I like that, right?
Yeah.
So that's
Plus
like one type of an example. And then, there are others that have different, but that one sort of jumps out at me as sort of interesting.
And you're more or less covered by the regulatory requirement that has to be switched out over time. So that there's going to be, turnover, right?
Oh, no. Well, yeah, I mean, well beyond that,
Yeah.
if you're in the business and you've done your homework and you continue to do your homework, and you have a operating team that's out there in the marketplace, feeling the market out, you don't just know that there might be some, American schedule, for the next 8 years. And they deal with an MRO, which is like a mechanic shop. Those shops, if you're in the market talking to them, they say, yeah, I need at least 30 of these units over the next 12 months. So you're basically providing them something that they need. So, I mean, if you were that aggressive, you could almost try to corner that market. I mean, that's a whole bigger game. But
Yeah.
for us, it's about knowledge of when things need to be provided, and we can provide them. You make a fair spread. And that type of an investment can be a 20% cash on cash business.
Wow.
That's real money with no leverage. That's
Yeah.
just just a business. Because that's, if you, again, think of what it is. It's a business that someone, traders could do, right? And they would make a spread. And now, because we're financing them, think about what they can say in the marketplace. We can buy and sell, which is what a trader does, or we can buy, hold, and sell. Once you have capital, you now are much more, have a big advantage over your other trading facilities.
Yeah.
So
That's a
we're
nice
sort of that
margin.
capital behind the
Yeah.
scenes.
And is there much competition in that, or is the margin pretty much consistent?
Well, I mean, look, that market's pretty big. You think about all the planes, all
Yeah.
the landing gear. Is
Yeah.
there competition? Of course there is.
Yeah.
But people make their living trading that stuff. And we're just we're allowing someone to, instead of trade 20 units a year, they now trade 100. Now, of course, I mean, we just know, because we come from the trading world, the more you trade, the more you see,
Yeah.
right? So now they're in a bigger flow. They're at the trade show and someone goes, wow, I didn't realize you could take these down. You used to trade 1, 2, 3 at a time. Now you're doing 8 or 9 at a time. Oh, we have a financing partner that's captive to us. And now they're walking around the show and they're important.
Yeah.
And more people go, can you do a program with us? Because now I know that you'll show up with the gear. I would like to schedule with you. Well, now it gets fun,
Now
right?
it's 20, right? Yeah.
Right. And so I just think you have to be, it's a little bit of, you search around and you see a business and you go, wow, if with a little bit of capital, they could be so much more efficient. And then you have to approach them, you have to sell them on your idea, because you're like their little merchant bank. I mean, and once you're in, you're like sand and glue. Like they don't get you out and you don't get out. Like you better have done your background on them and them on you, because you're in it together for a while.
Yeah.
And so I like that. I think, look, repeatable business with good operators is a whole lot better than having to figure out if I want to jump into something new with someone new every time.
Yeah. So by the way, group, feel free to ask any questions as we go along here. I've got plenty, but please feel free to put it in the chat box of the Q&A. Sandy, you want to say hi real quick, or are you going to stay where you are there? It's okay either way. Can you give one more example? Because that was super interesting. Like, who knows that he was even a business, right?
Right. I mean, this one, I think I'm sure some people have maybe heard about, because it's sort of hot right now. But like the bourbon market is hot, right? Everybody wants brown liquor or more of it than the past. But there aren't many. There are many assets that go up over time due to age, right? I mean, if you think through it, cheese, wine, right? Bourbon, there aren't a lot, they might go up anyway, but they don't almost always go up. And now you have a big demand for people who are trying to come up with the next, whatever, a brand name vodka or bourbon. But the rick houses need to build out so many more of them. That's where bourbon barrels sit. So they need real estate financing, but again, pretty mundane. But they need the equity to build their real estate out, because the bank only lends them, say, 75% of the new real estate. So what we've been able to do with some of these specialized rick houses is we finance the bourbon, pour into the barrel at the beginning. That gives them the money to use that they would have otherwise had to go build more rick houses, to build more, to be able to store more barrels. Yeah. And bourbon barrels go up between years 1 and 4, maybe 12%. But by the 4th year, you become aged and it just shoots up, especially if the market, I'm not doing it, but the market is spending tons of money trying to get more people around this world to drink brown liquor. So it's a pretty nice investment. People have taken advantage of it already. There have been people who have been early to this. We were involved a couple of years ago, so we were early. It's an efficient market theory. It will shrink. It won't. But I think there's a 5-year run rate of anywhere from 12 to 24% unlevered just bourbon barrel financing with the right rick houses, basically. Because and at one point they won't need you anymore, but they need the money, and there's nothing else they can get the money from. But they either have to borrow, which they don't want to do, just randomly borrow, and against all of their assets, or they have to raise equity, or they have to sell the bourbon early because a
Futures or
7-year
something, yeah.
bourbon is worth a ton more than a 4-year.
Yeah.
So they don't want to do that. So we set up something where effectively we get paid preferred, and then we do a split on the ups. But if you figure out, and the preferred's a big double-digit preferred, like a 15.
So that's where the cash flow comes from. So you're deploying capital into it, you're financing the equity in the rick houses. So you don't get any money until you actually sell the bourbon?
In that one, we don't get it, but what you do, and we can control this, is you start selling. There is look, if someone desperately needs 5-year barrels, they know that 3 years earlier. I mean, they know that, they'll buy our 2-year barrel up a lot. So we'll start peeling off barrels at and then you basically, it's like building an apartment complex, and you're getting all your money back by selling the first 7 units, and the last 3 is where you get all your profit.
Yeah.
And so, it's a nice business. And then of course it's the same idea. We have a manager, we have people that, we give control to help us do this. But if they're failing, we can actually take the control and sell those on our own. And by the way, what you realize is it's a pretty liquid market. Like sometimes you wonder, you're like, oh, the stock market's liquid, the bond market. You know what? The bourbon barrel market, liquid, like more than you can imagine. Like that. There are brokers, there are traders. It's sort of beautiful to see. Like the world works, and sometimes in some of these things.
So I happen to be a bourbon drinker, and there's I have no idea how this all works, but as a consumer, there's certain brands that have managed to become, FOMO and limited, but they're not really limited, but it's kind of limited, and and it just makes the price of the bottles go out of this world.
It's look, I learned a lot about this stuff. I got lucky enough to get to try a lot of these, and some are much better than others, and there's the whole folklore of Pappy's, and it is as good as it sounds because it is. And but the truth is that's not the trade we're going after. We do get some options, and in like the brand name of when they bottle it, because you never know. But I would say, out of there are 20 bourbon brands all trying to capture lightning in a bottle. That's what they're trying to do, and one will. They'll get the right celebrity to hook on, and next thing you know, everyone wants that one, which is weird because you're like, it may not even be the best. It just might be the best marketed.
Yeah, exactly. But
at the end of the day, if you think about it, and actually I'm impressed by it just personally, think about just use Jack Daniels, just simple, just don't even do it. You pull that off the shelf in New York or in Dubai, same color, same taste.
Exactly the same, right?
Do you know how hard that is?
Yeah, I think it's really
give
hard,
them some credit, it's not as simple. You can't just make it. That is a very hard thing to do. So captive bourbon barrel companies, in my view, are much, 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 much more valuable than guys just trying to create this amazing brand. It is so hard to get the same, what they call mash in there, have it aged under the same conditions, and get it so that it's the same all over the world or country.
Consistently everywhere. Wow.
Very hard, harder than you think.
Yeah.
So pretty.
It's kind of like
good.
with Veuve Clicquot is that, it always tastes exactly the same.
Yeah, it's really hard to do that. So
super interesting. So talk about where you are with the I'm not going to get this right. There was a prior fund and now this new one, or this is the fund?
That's right.
Yeah.
We, our existing fund is coming to the end of its investment life. We raised a second, the next iteration of it, which is a 5-year fund. I mean, again, it's a little bit late. I mean, this discussion, we have the close is at the end of this month. We've already closed the first close, the second close is at the end of this month. But my belief is you want to stay in front of people because deal flow is probably as important, if not, I mean, nothing's more important than capital, because if you don't have it, you can't spend any money. But deal flow is probably the next most important thing, because without it, you're waiting for brokers to call you. We spend hours every week, the whole staff, outbound calling, because it's the best way to find out what's really out there and what's real. So it's a 5-year fund, pretty standard structure and all that stuff. 3C7, so it's really, we keep it so that it's a sort of a very high net worth standard, but we really lean on our investor base to provide deals. I mean,
business development. Yeah.
Well, it's, what, a lot of them see deals. They don't want to go do the research or the work. They're just busy. We say, just throw it over the transom. We'll do it. We'll report back and say, nah, it wasn't for us. I didn't like it. Or let's pretend we do it. We'll then offer that investor side-by-side rights for free, because our view is we never would have seen it but for you. And the rest of the investors would never have had this opportunity but for you. That actually has been a pretty robust sort of sale to get people to say to me, which I like, they're on the soccer field with their kids and someone says, hey, my brother-in-law has a business and there's an issue and you're in the finance world or you're wealthy, so I'm telling you. And the person goes, you know what, I'm going to do you a favor and just introduce you to these guys. And believe it or not, like, one thing does lead to another. And many times that's how great deals and investments, sometimes it's not even with the person that was introduced to you, it's you learn about the industry they're in. I mean, the bourbon, by the way, was introduced to us, just to give you just an example, on funding a person who was trying to start a new brand. That's not what we do. It didn't work. But when we learned more about how you find the bourbon to be in the glass, we looked into the glass market, and that wasn't great for us. We didn't love it. And then we went into the liquids. Then we went back to the bourbon barrels. And then we went to the rick houses. And 2 years later, we're like, okay, we found the part of the chain that needs liquidity and that's stuck. Yeah. And it's too small for the bank to care. And it's too big to round up enough people. Yeah. And so that's where we play. So
super interesting.
And if you think of any business that has a chain like that, they all do.
Yeah.
And there's always a kink somewhere.
And it makes so much sense. I don't have to agree with you just to agree with you, but not having any friction on that side investment makes so much sense, because like you said, you wouldn't have otherwise seen that. So you don't need to charge them for their allocation to that, right? You just put it in the fund and get that the amount of money that you deploy through the fund to make your vig on, so to speak. Right. Are you looking at that question?
I am. I'm looking at a question, and basically the question was simply, do we only do where we buy and then do this, or do we just do traditional loans? The answer is, of course, we do traditional loans. I'm not against them. I'm against being in a loan that makes you feel good and isn't good, meaning I'm subordinated debt and I've got a security. Well, what does that mean? That means I'm second lien and effectively I got nothing, or I mean,
and you have no control, right?
Right. Yeah. Like, we set up some of our investments where we're preferred equity, but there's no debt, and the equity doesn't allow any debt to be put on top of us. Now, very different. By the way, I might get capital gains treatment. Terrific. I like that. If I set it up correctly and there's a problem with the company, I can convert that into equity and own the company without having to go to bankruptcy.
Yeah.
I like that. But it's weird, because I'll tell my investor base, or I'll tell people, well, I'm secured. Well, the truth is I'm not secured but I've got no debt above me. And I control that, so I don't allow it above me. And I'm really controlling the strings if there are any problems or issues going on. But then there's equity below me that has to obviously make a more money than I would as a preferred, because you're preferred for a reason. I mean,
Yeah.
so I don't mind a regular run of the mill loan. But if I do, I don't want debt around me. Like, at least I want to be alone. Um,
Yeah.
that's the best. And so good loans are good. Like regular loans, they're fine too. But again, this all has to do with the operator or who you're lending to, because the reality is a good ethical operator and you're an ethical lender, you figure stuff out.
Yeah.
When you're starting to talk about creditors' rights and debtors' rights, um, you've lost already, in my view. I mean, because then they start saying, well, you can't really take this. Because, in bankruptcy, we have sort of an equity bankruptcy world, they give the debtor a chance. And so as the lender, you're sitting there. If you have an operator who really starts having that issue, you're at odds, not good.
Yeah.
So I think a lot of this is about relationships, about communicating, and not about being like, it's easy to get a viscerally negative, like you find out how people react when bad things happen. If through COVID you were able to figure stuff out, you'll probably be able to figure stuff out.
Yeah.
And some of the people that we did lend to like decided not to pay. And I'm like, you really? Why don't you just call and say you can't? And we'll probably work with you. Like, I mean, you can't get blood from a stone. So,
Yeah.
but some people just react differently.
Yeah.
It takes a lot of upfront work to try to make sure you're not getting in bed with people who aren't any good.
Yeah.
And vice versa, because they look at us and go, are you a loan to own guy? Are you going to really put the screws to me? So I have to prove to them that that's not our goal.
Yeah.
Our goal is to make what we think we were supposed to make. No more.
And get our money back. Right.
And get our money back.
So what's and this is probably really not a fair question, but when you wrap up this raise, are you going to do over 5 years, 20 or 30 deals, 5 deals?
Yeah, no, it won't be 5. It'll be, we try to go across anywhere from 7 to about 10 platforms. Like we talked about bourbon barrels, we talked about, there's the platforms that we work on.
Yeah.
But within those, you could have 2 to 3 each. So could you see 25 or 30 investments go in and tail off? You could. But it's usually they've got, we do a lot of real estate up the East Coast, in the Southeast. That to us, that doesn't mean I'm good at it up the West Coast. It doesn't mean I'm good at real estate in the middle of the country. It means I'm very specific because of the builders we know and the operators. And so I might do 4 deals in this fund. Is it 4 deals or is it one program? But when you go and step back, it'll be in the 20 to 30 number of deals at, 6 to 10 million a piece, maybe 8 to 12 million a piece. So you're talking about $200 million to work. We'll probably then have SPVs because there'll be things that'll be bigger than what the fund can take. And we'll want to then first go to our investor base, but then go outside of it to see what other people would want to do. And then there are opportunities, though, we don't pursue them as much as we either should or have the time to, where they don't fit the fund's parameters because they're too low, say, on a return, or they're too risky, one of the two, but they're still worth a shot. And there might be an investor base that would like to take that, understanding the risks. Our problem is, you can't do everything. And, you got to spend the time at what you've told people you're going to spend the time doing. So,
and bandwidth is an issue. There's no
bandwidth
question.
is a big issue. I mean, these are high. I mean, we write it in our letters all the time. These are very high touch investments. And I like it that way because at least I feel like, and maybe I'm right, and sometimes I'm wrong, that I have my finger on the pulse of the investment. So when I tell the investor, this is what I think is going to happen, at least at that moment, I feel confident that I know that I'm telling them what I think is going to happen. It's not just
with the fact pattern that you have. Yeah.
Yeah. Right. So, we call it observable data. If I see observable data of me flipping, say, airplane part, landing gear for 38%, I think in that world, I don't tell you I'm going to flip it for double. And I certainly don't tell you I'm going to flip it for 5%. But if I'm getting 30 to 40% on every one, I can sort of I can start seeing my outcomes better.
Yeah. So is the structure a private equity drawdown with return of capital, or is it just, yeah, okay.
Yeah, it's a very simple structure. It's exactly that. It's a 30-month drawdown. It's a 60-month fund. We basically have to start giving money back after that 30 months. We in the last fund started giving money back after, I think it was either the 18th month or the 15th month. You know, I mean, I think our investors like this, but I like it as an investor. We basically, as we're hitting our, 90+% invested, we've already given back about 30% of the money. So the investors, at least in this fund, never had more than about 60% of their capital at risk at any one time.
Yeah.
I believe that it's your money. So if I get it back and I don't have a reusable use for it immediately, I'd rather give it to you. And then if I have a call period, I can always call things back. But money in your hands, or at least I know as an investor, money in my hands is better than money in the other guy's hands. So we take it when we need it and we give it back when it's done.
Yeah. On the other hand, if I've got capital that's not being deployed, I'd rather give it back to you.
You would, or you might have another thing that comes along.
Yeah, right.
I mean, my answer is I'm not going to be the best for you all the time,
Right.
but you make a commitment to me. I will use the commitment, but by the time I use the back end of the commitment, I've usually given you back a lot of the early monies I took. Just because of my deals are, I structure them as 18-month to 3.5-year deals because I know I have a 5-year life.
Yeah.
So if I start playing with fire and doing everything that's 5 years, I'm sure I'm going to then end up having to ask for extensions and tripping.
All that business. Yeah. Yeah. So what's the target raise?
Well, the target, we're pretty much at the target. The target was about 200 million. I think we're like, or it could be 210. I mean, I'm not going to stop. We're at about 190. So, the first close closed in late October. We have, we've put about 10% of the money to work. We put about 10% a quarter to work. We're not in a rush. Like the goal here is not to take your money and flood it into the market because the idea is be patient, use the 30 months. You can take your money and put it in the S&P or whatever, just have it readily available so that when I call for it, you're able to send it. I don't know what's around the corner. I don't know if this market's going to fall apart or not. Of course, I would love for it to, because then I'd have better buying opportunities. But of course, I wouldn't like it because then my already invested capital will struggle more.
Yeah.
I mean, that's life, right? So, but my answer is don't think you're the smartest guy immediately at a moment thinking like you suddenly figured out the future. I think that's ridiculous. You'll get it right once and then you'll get it wrong 5 other times.
Yeah.
Just invest under the cadence that you tell people you're going to do. That's the goal. And by the way, I'd rather, as much as it sounds ridiculous in some ways, I'd rather underinvest than overinvest, because then at least you're making good decisions under your own terms. Because what I find is one of the greatest powers you have as an investor is the ability to say no.
No.
Like that is the biggest one. It's not for me. Person bitches, they tell you I need it by Friday, and I go, but then I'm not the one. I need more time. You're too hard to work with. Okay. That's my now. If you can get comfortable with that, I think you can actually make good investments. If you feel this pressure that I better put money to work, you're bound to make mistakes.
And look, what we said at the beginning of the conversation before we went live is just say next, right?
Right.
Just
and by the
next.
way, sometimes you will, and you will miss a great one. I don't know what else to say. Oh, well. I mean,
Yeah.
By the way, just remember in the back of your mind, there's loads of investments you don't even see that you're missing. So like, I'm sure if you hang a shingle out there and say, I'm here to put money to work, a lot of people will knock on your door.
Exactly.
And, we go through, we put in our deck like 1,000 a year, but it's thousands because so many people come as, I need 2 million on a 10 million valuation. Like that doesn't even count. And we're just like, that's not for us, not me, not us. And, if you go out looking for deals, it's unbelievable how many you find. The hard part is curating them.
Yeah.
Like that's the hard part.
No doubt. So what do you think about, are you going to have a hard close? Is there time to get in if the people are interested?
Yeah. On this one, we have enough early investors many of them were from our first fund. And though I know this is late and I know we tried to set this up earlier and stuff,
Yeah.
we really, I'm not a huge fan of second, third closes where people can see what you've already done and pay a small payment to the people who took the risk. And
Right. Yeah.
and so,
Kind of
I'm
unfair,
allowed,
right?
yeah,
Yeah.
and I know that's a weird thing, but I can stay open a year, but I'm not going to.
Yeah.
On this one, we'll close probably I think it's February 4th, or we'll come up with a line in the
Yeah.
sand, because that's
Yeah.
the Friday after the end of the month. And then, you know what? I want to stay in touch with you and your group because
Yeah.
there's deal flow, but in 24 months, we're going to be back in the market doing it again because
Yeah.
we'll have spent this money and
Yeah.
we'll have a new fund.
Yeah.
And that's how you build and people can then see if we do what we say we're going to do and get the results we say we're going to get.
Yeah, look, it's the same thing you said, but in a different application. Is by the time you meet somebody who can write a check, and when they do, you don't know what that is.
Right.
So, right. So you
So,
just have to, yeah.
I mean, the thing I like about at least, and I look, I obviously we all hope that COVID subsides and also is one of the things we're trying to do with our ecosystem is if we have 150 wealthy families and individuals, getting them to get to know each other, either because we do something like this, with you, or we do it where we used to do it like where we would rent a room in the city and people would come. Like then what happens is like sparks fly between
Yeah,
other
yeah.
people. And
Yeah.
all
Yeah.
I say is don't forget me and don't forget the fun. Like I'm in, let us be part of it, let my family be part of it because I don't know who knows whom, who knows
Yeah.
who. And
Yeah.
I'm trying, but I know that I have a lot of very smart, very well-off investors who have expertise in very different areas. And, if they can connect, you don't know what they can create, And
Exactly.
so
Yeah.
we try to do dinners, we try to do, well, now it's Zoom calls. We try to do things to cause that connection. COVID sort of put a kink in that pretty
Yeah.
badly,
Yeah.
unfortunately.
Peter, I think you know this, but prior to COVID, we were doing 2 or 3 luncheons in a law firm or law firms, Midtown, 30 family offices. So one person would pitch, but that magic that happened in the audience was
Well, right. And your
unbelievable.
audience doesn't know Sandy as well, but I mean, she's the best at it. You know that,
Yeah,
I
yeah.
mean,
You are
that's,
too kind.
There you are. There's
I mean,
Sandy.
but that is gold. I mean, to
Yeah.
me, because you see it. And by the way, if you've been an investor long enough, which probably a lot of your, people, that are on this and your system do, you can see it. Like you see, it's
You
like
recognize it.
focusing.
Yeah. Yeah.
Right,
Yeah.
it's like focusing binoculars. Like
Yeah.
finally, you're like, got it. And
Yeah.
then when you're around it, I mean, for me, I go, this is amazing because sometimes it's not my idea, it's someone else's, and I'm like, I want to be part of that,
Yeah. Exactly.
and
Happens all the time. Yeah.
and that's, I mean, and that I think is where good investors really make a lot of money. It's not always the investment you're in; it's keeping your mind open to see the other ones that connect. And instead of just getting myopic about that one, you go, like, for instance, I'm just on the bourbon barrels. I don't even know where it's going yet in that, but I'm saying, well, what about the oak, the barrels? Like, who makes those? Where's the wood coming from? Like, you never know where you go, oh, I got it. Like
Yeah.
that. And
Yeah.
it's like sometimes the picks and shovels are more important than all
Yeah.
that kind of stuff.
Yeah.
So, that's the digging we try to do. And when you find it, you exploit it, and you exploit it to as best you can. And of course, if it were so easy, then of course the large funds would do it and they would drown you out and the efficient market would pick it up. But when
Exactly.
it's
And the
not
margins
that
would
much,
compress and
yeah,
yeah.
as it should,
Yeah.
by the way.
And look, the challenge with big BlackRock, whatever all the big is that they're itching to deploy capital. And
Yeah.
they've got big checks and they make impact and they have returns, but they've got to get rid of the cash, right?
Yeah. I mean, what I've seen, and I'm not saying it's right, if you're small, which is us, or if you're really big, you have an advantage because they use Blackstone as an example. Only so many people can take the monster amount down,
Yeah.
and it takes but if you're in the middle,
Yeah, yeah,
I just think you're going to get squeezed to nothingness
Yeah.
because like there, do you know, I mean, there are just gobs of people running around trying to write $38 million to $58 million checks. Like there's just gobs,
yeah.
you know? So then it's like, I'll do it at 11, I'll do it at 10, I'll do it at
Yeah.
9, 8, 7. At one point you're like, that's a lot. That's very little for the risk I'm taking.
Exactly. Yeah.
So in some respects, like, I mean, I have children who are in college and they're, coming out, and I'm like, I'd much rather be the company, the borrower than the lender of a medium need amount of money. Because if you have a good idea or decent business, money's plentiful
Yeah. It's
in that
plenty.
area.
Yeah. Super.
So,
Well,
Arthur, I wouldn't be doing my job if I didn't say that if anyone was on the call or did have interest, our first round was anchored by an endowment, so we've been through a lot of due diligence and happy to have a conversation around or provide access to data room if anyone was serious in the next few weeks. We'd be happy to be doing that.
Yeah, super appreciate that. We're going to make sure that everybody who registers is going to be in touch with you directly, and you'll have the list, and so you can launch out that offer, via email, of course. And thanks for adding that. Yeah, Sandy, I mentioned this to Peter before the call, but for the group, Sandy is New York City, East Coast based, which is what I am, but we just happened to have breakfast yesterday because she was skiing in Park City. So we were glad to meet. We had met before, but I got to meet David as well. So thanks for that, Sandy. It was super cool. I enjoyed it.
Totally.
And thanks for letting us do this. Can we do it again?
We could do it again. I love it.
Just for, even sort of updating deal flow and that sort of thing, and keeping in touch with the community. It'd be this super fun and my pleasure to do it, and really enjoyed it. And so is that okay?
Of course. Thank you, Arthur.
Yeah.
Thank you.
Yeah. So again, thank you for doing this. Really, really fun, very interesting. And as I always say to the community, thank you for sharing with us the only thing you can't make more of, and that's your time. So till next time, thanks. Take care, guys. Bye-bye.
Bye-bye.